Starting to invest might feel intimidating, especially when you're not sure where to begin or when the right time is. However, waiting for the perfect moment to start investing is a mistake that many people make. The truth is, there is no perfect time to start. There's only the present. If you wait for conditions to be ideal, you may never get started at all. The best way to build wealth through investing is to take that first step today, no matter where you are in your financial journey. The idea of waiting for the perfect opportunity can often be paralyzing. Many beginners think they need to have a certain amount of money saved up, or they think they need to understand everything about the market before they can start. However, this type of thinking only holds you back. In reality, investing is a process, and the earlier you start, the more you benefit from the power of compound growth. The money you invest today has the potential to grow over time, and that growth only accelerates the longer you keep your money in the market. This is why time is one of your greatest allies when it comes to investing. One of the main reasons people delay investing is due to fear of making mistakes. It's natural to be worried about losing money, especially when you're starting out, but let me assure you, every investor, no matter how experienced, has made mistakes along the way. The key is to learn from them and adjust your strategy accordingly. By starting early, you give yourself more time to make mistakes, learn from them, and still come out ahead. The longer you wait to invest, the fewer opportunities you have to learn and grow your portfolio. Another reason people delay is the idea that they need a large sum of money to begin investing. While it's true that some investment opportunities require significant capital, there are plenty of options for beginners who don't have much money to invest. Many investment platforms today allow you to start with as little as $1, 0 cents. Thanks to the rise of fractional shares, you can invest in high-priced stocks with just a small amount of money. The idea that you need to wait until you have thousands of dollars to invest is a myth. You can start small and gradually build your portfolio over time, learning as you go. Additionally, starting to invest today allows you to take advantage of dollar cost averaging, which is one of the best ways to reduce the impact of market volatility. Dollar cost averaging involves investing a fixed amount of money at regular intervals, no matter what the market is doing. This strategy helps to mitigate the risk of investing a lump sum at a time when the market may be overvalued. By spreading out your investments over time, you take advantage of market fluctuations, buying when prices are low and still benefiting when prices rise. This approach removes the emotional aspect of investing, which often leads to poor decision making, and instead relies on consistent long-term growth. Many people are also held back by the fear of market fluctuations. Stock markets can be volatile, and the thought of investing in such a fluctuating environment can be overwhelming. However, it's important to remember that market fluctuations are normal. In fact, they are an integral part of investing. The market will go up and the market will go down. But over time, it has historically trended upward. If you try to time the market, you are likely to miss out on the long-term gains that come from staying invested. The key to successful investing is to remain patient and ride out the short-term fluctuations. By investing early, you give yourself the time to recover from dips in the market and still reap the benefits of long-term growth. In addition, starting to invest today allows you to take advantage of tax benefits, such as retirement accounts like IRAs and 401ks. These accounts allow your money to grow tax-deferred, meaning you won't pay taxes on your gains until you withdraw them in retirement. The earlier you start investing in these accounts, the more time your money has to grow, and the more you can benefit from these tax advantages. If you wait too long, you may miss out on valuable tax benefits and have less time for your investments to compound. Getting started with investing also helps you build the discipline of regular saving and investing. The act of committing a portion of your income to investments every month will help you build a financial habit that can pay off in the long run. It forces you to think about your financial future and prioritize your goals. Over time, this habit will become second nature, and you'll find that you're consistently putting money into your investments, making it easier to grow your wealth. Another important reason to start investing today is the psychological aspect. When you invest early, you feel empowered because you are taking control of your financial future. You're no longer waiting for things to happen, you're actively shaping your future wealth. This sense of control can also have a ripple effect in other areas of your life. It builds confidence, helps you become more financially literate, and puts you on the path to achieving your financial goals. In conclusion, waiting for the perfect time to invest is an illusion. The perfect time is now. The sooner you start, the more time your money has to grow, and the more opportunity you have to learn and refine your investing strategy. Start with whatever you can, learn as you go, and stay disciplined in your approach. The key to success in investing isn't about waiting for the right moment. It's about getting started, taking consistent action, and building your wealth over time. Don't wait for the perfect opportunity. Create it by starting today. Educating yourself about investing is one of the most crucial steps on the path to financial success. It's easy to feel overwhelmed with the vast amount of information available, but it's important to break it down and focus on the fundamentals. Investing isn't just about putting your money into random stocks or assets and hoping for the best. It's about understanding how different investments work, how they align with your goals, and how to manage risk. The more educated you become, the more empowered you'll feel to make sound decisions with your money. The first step in educating yourself is understanding the basic types of investments. There are several ways to grow your money, but each type of investment comes with its own set of risks and rewards. The primary investment vehicles you'll encounter are stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate. Each one works differently, and it's essential to know the pros and cons of each before you start investing. Stocks represent ownership in a company, and by buying shares, you're investing in the future growth of that company. If the company does well, your shares may increase in value. However, stocks can also be volatile, and their value can fluctuate based on market conditions, company performance, and overall economic factors. Bonds, on the other hand, are essentially loans made to corporations or governments. When you buy a bond, you are lending money in exchange for regular interest payments and the promise of your principal back when the bond matures. Bonds are generally considered safer than stocks, but they offer lower potential returns. Mutual funds and ETFs are both investment vehicles that pool together money from multiple investors to purchase a variety of assets, including stocks, bonds, and other securities. The main difference is that mutual funds are typically actively managed by a fund manager, while ETFs are passively managed and track an index like the S&P 500. Both mutual funds and ETFs allow you to diversify your investments, but ETFs often come with lower fees and offer the ability to trade throughout the day like individual stocks. Real estate is another investment option that allows you to invest in physical properties. While it can require a larger initial investment and comes with its own set of challenges, real estate can provide a steady stream of passive income through rental properties and the potential for significant appreciation over time. Each of these investment types has its place in a well-rounded portfolio, and understanding how they work is key to making informed decisions about where to put your money. Once you understand the basic types of investments, the next step is to learn about the concept of risk and reward. Every investment comes with some level of risk. It's important to understand that higher potential rewards typically come with higher risk. When you make an investment, you should ask yourself, how much risk am I willing to take to achieve my desired returns? This is known as your risk tolerance. Your risk tolerance will depend on several factors, including your age, income, financial goals, and personal preferences. For example, if you're younger and have a long time horizon before retirement, you may be more comfortable taking on risk with the expectation that your investments will grow over the long term. On the other hand, if you're nearing retirement, you may want to adopt a more conservative approach and focus on preserving your capital rather than seeking high-risk, high-reward investments. Understanding your risk tolerance helps you choose the right investments that align with your financial goals and comfort level. Another key concept in investing education is diversification. Diversification is the practice of spreading your investments across different asset classes to reduce risk. The idea is that different types of investments will perform well at different times, so by diversifying, you can smooth out the overall risk of your portfolio. For example, stocks might do well when the economy is booming, but bonds tend to do better when the economy is struggling. By holding a mix of stocks, bonds, and other assets, you can protect yourself from the volatility of any one investment. It's also essential to understand the role of fees in your investments. Investment fees can eat into your returns over time, so it's important to know what you're paying and how it will impact your investment performance. Some investment products, such as mutual funds, charge management fees, which can be relatively high compared to other options like ETFs. Over the long term, these fees can have a significant impact on your returns, so it's important to compare costs and choose investments that align with your financial goals while minimizing unnecessary fees. Another area to focus on is understanding the basics of taxes and how they impact your investments. Different types of investments are taxed in different ways, and understanding how taxes work can help you keep more of your money. For example, capital gains tax applies to profits made from the sale of investments like stocks or real estate. Depending on how long you hold an investment, the tax rate on capital gains can vary. Long-term capital gains for investments held over a year are typically taxed at a lower rate than short-term capital gains for investments held for less than a year. Additionally, certain tax-advantaged accounts, such as 401ks or IRAs, allow you to grow your investments tax-deferred, meaning you won't have to pay taxes until you withdraw the money in retirement. Beyond understanding the financial aspects of investing, it's also important to develop a mindset for successful investing. Emotional control is essential for success in the markets. Many people make the mistake of reacting to short-term market fluctuations by buying or selling based on fear or greed. Successful investors understand that market fluctuations are normal and avoid making impulsive decisions based on temporary emotion. They focus on long-term growth and stick to their strategy even when the market is volatile. As you continue to educate yourself, it's important to remain patient and disciplined. Investing is a long-term game, and the more you learn, the more you'll realize that successful investing is about consistency, not trying to time the market or chasing quick gains. The best investors are those who stay committed to their strategy, continuously educate themselves, and remain calm in the face of market ups and downs. In summary, educating yourself about investing involves understanding the various types of investments, assessing your risk tolerance, diversifying your portfolio, learning about fees and taxes, and developing the mindset needed to stay focused on your long-term goals. The more you learn, the more confident and capable you will become in making wise investment decisions. Setting clear financial goals is one of the most important steps you can take on your journey to financial success. Without a clear vision of what you want to achieve, it's easy to drift without purpose or direction. Financial goals act as a roadmap for your investment strategy and give you a clear sense of purpose. They help guide your decisions, keep you focused, and provide motivation when times get tough. The key to successful investing is not just to invest money, but to invest with intention, so that each dollar you put to work is moving you closer to achieving your unique financial goals. The first step in setting financial goals is to define exactly what you want to achieve. This can be as broad or as specific as you want, but it needs to be clear. For example, if your goal is to retire at 65, you need to break that down into specific sub-goals. How much money will you need for retirement? How much do you need to save each month to reach that target? Setting concrete, measurable goals gives you the framework you need to make informed decisions about where to invest and how much to put aside. One of the most common financial goals people have is to save for retirement. Retirement planning is one of the best ways to ensure financial security in the future. But to plan for retirement, you need to have a solid understanding of how much money you'll need and when you'll need it. Will you need to replace 70%, 80%, or 100% of your current income once you retire? Once you establish how much you need to live comfortably during retirement, you can calculate how much you need to save each year to reach that target. Another common financial goal is buying a home. Home ownership is one of the most important financial milestones for many people, and saving for a down payment is often the first step in achieving that goal. However, it's not just about saving for the down payment. It's also about understanding the cost of home ownership, including mortgage payments, taxes, insurance, and maintenance. Setting a goal to purchase a home requires detailed planning and a realistic approach to saving and budgeting. Similarly, paying off debt is another crucial financial goal that many people set for themselves. Whether it's credit card debt, student loans, or mortgage, becoming debt-free is a common and important financial objective. The key to paying off debt is setting a realistic timeline, creating a budget, and allocating funds to reduce your debt every month. Once you've paid off high-interest debt, such as credit cards, you can start saving and investing more aggressively. When setting financial goals, it's also important to consider the time frame for each goal. Long-term goals, such as retirement or buying a house, may require years of saving and investing. But there are also short-term goals you should consider, such as creating an emergency fund, buying a car, or taking a vacation. Short-term goals can give you a sense of accomplishment and keep you motivated as you work toward your long-term objectives. By balancing both short and long-term goals, you can stay on track and feel accomplished as you check off milestones along the way. Once you've defined your goals, you need to quantify them. How much money do you need to achieve each goal? This is where you start turning your financial dreams into a reality. For example, if your goal is to retire with $1 million, 0 cents, by the time you're 65, break it down further. How much do you need to save every month, and what rate of return do you expect on your investments? This process forces you to think critically about the numbers and helps you create a roadmap for how to get from where you are now to where you want to be. When setting goals, it's also essential to determine how you're going to measure your progress. Without measurable checkpoints, it's difficult to assess whether you're on track to meet your goals. For example, if your goal is to save $10,000, 0 cents, for a down payment on a house in 2 years, set monthly saving targets so you can track your progress. Measuring your progress regularly will help you stay focused, make adjustments if needed, and celebrate the milestones you hit along the way. It's also important to be flexible with your goals. Life happens, and unexpected events can throw off even the best laid plans. You might experience an unexpected job loss, an illness, or other life events that make it difficult to save or invest as planned. It's important to be adaptable and willing to reassess your goals when necessary. This doesn't mean giving up on your goals, but rather adjusting your approach to account for new circumstances. Being flexible allows you to stay committed to your financial future without feeling discouraged. Along with flexibility, it's important to prioritize your goals. While saving for retirement might be your primary long-term goal, you may also have other priorities, such as paying off debt or building an emergency fund. Prioritizing these goals can help you allocate your money more effectively. For example, if you have high-interest debt, it may make sense to focus on paying that off first before aggressively saving for retirement. Balancing multiple financial goals requires planning and a commitment to working toward each one, even if it means focusing on one goal at a time. Once you have a clear plan in place, review your goals regularly. Your financial situation will change over time, whether it's because of an increase in income, a change in expenses, or a shift in priorities. Periodically reviewing and adjusting your goals ensures that they stay aligned with your current financial circumstances and future aspirations. This ongoing process of reassessment is what keeps your financial plan relevant and keeps you on track to meet your objectives. Lastly, stay motivated by celebrating your wins, no matter how small. Financial goals can feel overwhelming, especially when they seem distant or large. But every time you reach a small milestone, take a moment to appreciate your progress. Whether it's saving your first $1,000, 0 cents for a down payment, or reaching the halfway mark of your retirement savings goal, celebrating these wins helps keep you motivated and focused. The journey to achieving your financial goals is just as important as the destination, and acknowledging your progress along the way makes the process more enjoyable and rewarding. In summary, setting clear financial goals is the first and most important step toward achieving financial success. By defining your goals, Understanding the timeline, breaking them into actionable steps, and measuring your progress, you create a blueprint for your financial future. With persistence, flexibility, and regular reviews, you'll be able to turn your financial dreams into reality and build a secure and prosperous future. Discipline is often the differentiating factor between those who achieve their financial goals and those who struggle to make any real progress. It's easy to get excited about a goal or an investment strategy, but maintaining focus and staying committed over the long term is what truly leads to success. Whether you're investing for retirement, saving for a home, or building a business, discipline is the force that keeps you moving forward. Without it, even the best intentions can quickly fall apart. Discipline is about doing what needs to be done, even when it's not easy, or when immediate rewards are not in sight. The first element of discipline is consistency. Success is not a result of sporadic effort, it's the result of consistent, repeated actions over time. Whether you're saving for a down payment on a house, building an emergency fund, or contributing to your retirement plan, consistent contributions are essential. If you can commit to investing a fixed amount each month or sticking to a budget, you'll see progress even if it feels slow at first. The beauty of consistency is that small, steady actions accumulate over time. In the beginning, you might not see much change, but over time, your wealth grows exponentially. This process, known as the power of compounding, can be your greatest ally in achieving financial independence. Consistency also means sticking to your financial plan when things get tough. The markets will fluctuate, there will be unexpected expenses, and sometimes it will feel like you're not making any progress. But this is when discipline truly shines. When you stay the course, even in the face of adversity, you build resilience. Many people abandon their plans when they encounter challenges or when things don't go as expected. But disciplined people understand that setbacks are a normal part of the process, not reasons to quit. They focus on the long-term vision and avoid being sidetracked by temporary hurdles. Another important aspect of discipline is delayed gratification. We live in a world that encourages instant rewards, whether it's fast food, next-day shipping, or social media validation. But in the realm of investing in personal finance, delayed gratification is critical. The decisions you make today, how you spend your money, what you invest in, and how much you save will determine your future financial security. This means saying no to short-term indulgences so that you can invest in your long-term goals. For example, rather than spending money on non-essential luxuries, you choose to save and invest it, knowing that the payoff will be far greater in the future. Delayed gratification also requires understanding that wealth building is a slow process. Quick wins and overnight riches are rare, and chasing them often leads to poor decisions and financial losses. Wealth is built incrementally. By committing to the discipline of saving and investing regularly, you allow your money to grow steadily, even when the results are not immediate. The beauty of delayed gratification is that over time, the sacrifices you make in the present will pay off in spades in the future. Discipline also involves the ability to say no. Every day you are faced with choices that can either move you toward or away from your financial goals. It's easy to succumb to impulses, buying the latest gadget, splurging on unnecessary vacations, or dining out frequently. However, disciplined individuals know that saying yes to everything can quickly derail their financial progress. Saying no to unnecessary expenses allows you to redirect that money toward things that truly matter. Whether it's paying off debt, saving for a home, or investing for the future. Saying no is a powerful tool in maintaining control over your finances and staying focused on your goals. Building discipline also requires the ability to track and monitor your progress regularly. Without regular check-ins, it's easy to lose sight of your goals or become complacent. By keeping track of your financial progress, whether it's through budgeting, investment tracking, or goal setting, you maintain accountability. When you regularly review your finances, you can identify areas where you're doing well and areas that need improvement, and this helps you stay focused and motivated, especially when progress feels slow or when you encounter setbacks. Tracking your progress provides a clear picture of where you stand and what you need to do to stay on track. Additionally, discipline involves making informed decisions and avoiding impulsive actions. It's easy to make emotional financial decisions based on fear, greed, or excitement, but these decisions often lead to regret. Discipline means taking the time to educate yourself, weigh your options, and make thoughtful, well-informed decisions. This approach may take more time, but it is far more rewarding in the long run. Instead of reacting impulsively to market swings or sudden financial opportunities, disciplined individuals take the time to evaluate their options, align them with their long-term goals, and then make decisions that are in their best interest. Discipline is also essential when it comes to maintaining a budget. Budgeting isn't just about keeping track of your spending, it's about having the discipline to stick to the limits you set for yourself. Budgeting requires honesty, focus, and self-restraint. When you create a budget, you're telling yourself where your money should go and what you can afford. Sticking to that budget, no matter how tempting it is to overspend, is an important demonstration of financial discipline. The better you get at sticking to your budget, the more control you have over your finances, and the closer you get to achieving your financial goals. One of the best ways to cultivate discipline is by automating your finances. Setting up automatic savings or investment contributions means that you're investing in your future even when you're not thinking about it. This reduces the temptation to spend money frivolously and ensures that you're consistently working toward your goals. Automation creates a system where saving and investing are not optional but automatic, making it easier to stay disciplined, especially during times of temptation. Finally, discipline requires a strong sense of accountability. Having someone who holds you accountable, whether it's a financial advisor, a spouse, or a close friend, can provide the motivation you need to stay on track. Sharing your goals and progress with someone you trust ensures that you remain committed to your objectives. Accountability also helps you avoid making reckless decisions, as you know you'll have to report your actions to someone else. Discipline, then, is the cornerstone of financial success. It's what keeps you focused, consistent, and committed to your goals, even when things get tough. By practicing discipline in all areas of your finances, whether it's saving, budgeting, investing, or making financial decisions, you create a strong foundation for your financial future. Success isn't about making the perfect decision every time. In conclusion, achieving financial success and building wealth is not about sudden gains or quick fixes. It's about developing a mindset and a set of habits that allow you to make consistent progress over time. Starting early, educating yourself, setting clear financial goals, and cultivating discipline are the cornerstones of a successful financial journey. By taking small, deliberate actions today, staying focused on long-term objectives, and remaining disciplined, you set yourself up for a future of financial security and growth. It's a journey that requires patience, persistence, and a willingness to learn from mistakes. But with the right mindset and dedication, anyone can build the wealth and success they desire.